Wall Street carnage or golden opportunity? Stephanie Link calls out the AI bubble naysayers. Are investors missing a generational buying moment or about to catch falling knives?
The volatility in November, Andrew, that we thought we were going to get in September and October, because September, October seasonally are the weakest months of the year, and then it starts second half of October into the end of the year where you have the seasonal strength. I think you want to be buying the dips because the economy continues to chug along, and that is leading to better than expected earnings. Earnings are growing 12.5%. That is much better than historically the trend at 5%. And so I think that you use the volatility to buy some of the stocks that are getting hit. You buy some technology. I added to Meta. Last week, I added to Microsoft. This week, we had great numbers from Eaton, especially on the data center growth and orders. I added to Uber. They beat across the board other than EBITDA, but because they're spending to grow, and they are seeing growth. They just grew earnings 159% year over year, which is crazy good. Rockwell Automation, a very good number. And then I just added to Starbucks. It's a new position because I think that the turnaround is starting, and I want to be part of Brian Niccol and that whole team that's driving better results.
Those protein iced coffee at Starbucks, I think that's actually going to help. No joke. I'm not laughing about it. It's a serious thing. What wouldn't you touch in this market right now, Stephanie?
Well, I know everybody wants to kind of bottom fish in energy right now. I'm not a believer. You have an administration that wants a lot lower oil prices, and I think you're going to get it. And so I think that group is more of a value trap more than anything. I really wouldn't touch any of these meme stocks, obviously. That's the one worry point. If you ask me, you know, kind of what do I watch? I'm watching those stocks. Thankfully, they're not big pieces of the overall market, but the activity is certainly, I wouldn't say worrisome, but it's just something worth to watch. But I would not touch them at all.
But
I think there's a lot you can be buying.
Well, the elephant in the room is whether this is the beginning of a big sell-off in AI or not. And it's, you know, maybe it's not a bubble, but there's at least some air that's inflated because you can look at the gains that you've had in those stocks over the past year and a half. They're stratospheric. So
yeah,
probably no one would deny that 2 or 3 years from now, the bubble or whatever, for lack of a better term, it's going to be even bigger, just like the internet, just like all the stocks we worried about that, you know, there were winners and losers. What happened in 1999, the winners were much bigger than any of us thought. Is that what's going to happen with AI? How much further do we have to go? That's the falling knife that Andrew's talking about. Or is it, I mean, they don't have to give back all the gains of the last year and a half, do they? But if they gave back half, we got a long way to go.
Right. Well, I mean, we have had really good run in the AI, the whole theme. But we're seeing massive amounts of spending happening because these companies can't meet the demand. They can't meet the demand. But it's not just hyperscalers
money doesn't exist,
that are spending.
Though. Right? Money doesn't even exist that they're supposedly spending.
No, first and foremost, the money does exist. There are companies that are monetizing. Let me give you a case in point on Meta and why I added to it. So not only did they grow revenues 26%, operating margins expanded, family of apps grew 26%, but advertising grew 26% and impressions grew 14%. And that enabled them to see price per ad up 10%. So they are monetizing it, right? So that is one of the, you don't want to own every single AI play, but you want to pick and choose where you're seeing companies where they're profitable and where I don't mind that they're spending to grow. But it's not a whole blanket statement of every single AI name. Look, we're going to have the AI, if you listen to a lot of different CEOs, the AI total addressable market went from 1 trillion expectations between now and 2030 to 4 trillion. Okay, let's just cut that in half, Joe. It's still an enormous growth rate, and companies that are profitable are worth buying on the weakness. This is not back in the internet bubble days where we were counting eyeballs for valuations.
Yeah,
right?
they're
talking
not all
about
the same.
PE.
Yeah, NVIDIA is not
exactly
expensive.
Right.
Some of them are at 200 times revenue or something, though. Some of the...
Yes. Yes.
And
yes. Look,
so it's not all the same.
It's not. It's not. I mean, look, I don't want to own companies that are not profitable. And I know those stocks have really run. I know those are part of the meme things. But if I can find, I mean, Meta just lost 20% in like 2 weeks, right? So why would I not buy something that's growing, that's profitable, or margins are expanding? Microsoft, they beat across the board. They had commercial bookings up 111%. Their cloud business is growing 39% for a company of this size, right? Amazon, throw them in there too, because that stock has lagged. So those are ones I want to own, and I do, but let's find other names too that are going to benefit from this whole theme. Eaton is a perfect example. Vertiv is a perfect example. These are companies that are helping build the data centers, and they are profitable, and the valuations are not extreme.